Most traders open their charts in the morning, see a setup, and place a trade. And then 10 minutes later, they're wondering, why did price do the exact opposite what the indicators were telling them? Almost every time that this happens, it's because they skipped three quick checks that would have told them not to take that trade at all. I've been trading for over 20 years, and these three signals are the first things I look at every single morning before I even open my charts. The whole routine takes me only about 5 minutes, and it stopped me from taking more bad trades than I can count. Let me walk you through it. Here's what happens when you skip this. You see a clean technical setup. The chart looks great. You take the trade, and then there's a piece of news that you didn't know about, a central bank comment, a tariff headline, a piece of economic data, and the price moves 80 pips in the wrong direction in about 2 minutes. It's not about that your strategy was wrong, it's that the markets was paying attention to something you weren't. This happens constantly to traders who look at the charts. With everything going on in the markets right now, you've got tariffs, geopolitical headlines, central bank rate decisions. Fundamentals are driving price action more than they have in years. If you're only reading the technicals, you're trading basically with one eye closed. The first thing that I check every single morning is risk appetite. So, what do I mean by that? What I mean is that stock futures are up or are they down? If stock futures are up, the market is on risk on mode. Investors are confident, market money is flowing into riskier assets in currencies like the Australian dollar, the New Zealand dollar, the euro, and they tend to do better. The yen and the dollar tend to weaken. If stock futures are down, it's risk off. Money flows into safe havens like the dollar, the yen, and gold. The risk currencies get sold. This one check tells me which side of the market I should be looking at before I even open a single chart. If I'm thinking about long Aussie, for example, and stock futures are deep in the red, that's an immediate warning sign. The market environment isn't supporting the trade that I'm about to take. This is the single most important signal to start with. If you do nothing else from this video, start your morning by checking whether stock futures are up or down. It's just as simple as that. The second signal is the economic calendar, and specifically what's coming out today and how that could affect your trade. Most traders, they glance at the calendar, see there's some news scheduled, and they trade anyway. That's a mistake. Here's what I do. I look at what's being released overnight to see if any of it changes the picture for the pairs that I'm watching. Then I look at what's coming out during the session that I'm about to trade. If there's a red card, high impact release on a currency that I'm planning to trade, like the Fed rate decision, inflation, or non-farm payrolls, I either wait for the release to come out before entering or I trade a completely different pair entirely. A real example from last week. The Fed had a monetary policy announcement coming up. Knowing that that was on the calendar, I didn't trade the Asia session the night before, and I stayed out of the dollar pairs that morning. The market was consolidating ahead of the announcement, which means there are a lot of false signals on the chart that could end up going nowhere, and it happens a lot. The setups looks clean, but the calendar told me the market wasn't going to commit to a direction until the Fed spoke. That one check probably saved me from 3 or 4 losing trades that day. The calendar isn't there to predict the news, it's there to tell you when to step aside. The third signal is the one that most traders ignore completely: headlines. I'm not talking about reading the news for an hour. I'm talking about scanning financial sites like Bloomberg, Reuters, the Wall Street Journal for 2 or 3 minutes. I'm looking for the big stories driving the market for that day, like tariffs, central bank announcements, geopolitical developments. Why does this matter? Because in this environment, one headline can override a perfect technical setup. Tariffs get announced, the dollar moves 100 pips. A central bank makes an unscheduled comment, the euro moves 50 pips. Or the central bank comes in and intervenes and moves 300 pips. If you didn't know the headlines were coming, your trade just got run over by something that had nothing to do with the chart. I used to put more weight on bond yields for this. They're still important, but with political headlines and tariff news driving so much of the action right now, headlines have become more important than yields for short-term direction. When central banks start actively raising or lowering interest rates, they'll shift back. For now, headlines lead. So how do you actually put this into practice tomorrow morning? Start with risk appetite. Open whatever you use to check stock futures. It takes only 10 seconds. Note whether the market is risk on or risk off. That's your bias for the day. Then check the calendar. What's coming out, at what time. Mark anything that's high impact to the pairs that you're trading. If something major is scheduled, plan to be flat ahead of it. Then scan the headlines. 3 minutes maximum. You're looking for the one or two stories that market is reacting to today. Now and only now, open your charts. The setups you take after the filters are going to be dramatically higher quality than the ones you take cold. Not because you've added complexity, but because you've stopped trading against the market. One last thing that I want to mention because I see it constantly. The biggest mistakes traders make with fundamentals isn't ignoring them. It's the opposite. They form a strong opinion about what should happen based upon the news, and then they fight the price action the market disagrees with them. Fundamentals tell you what to look at. That's important. Price action tells you when to act. The headlines might suggest that the dollar should weaken, but the chart is showing strength. You have to respect the chart. The market reflects how traders actually feel, not how you think they should feel. These three signals are filters, not predictions. Use them to decide what you'll trade and what you'll avoid. Then let your strategy do the rest. 5 minutes, three signals, risk appetite, the calendar, and the headlines. Do this every morning before you open your chart, and you'll start filtering out a huge number of trades that were going to lose you money. Not because the setup was bad, but because the market environment wasn't supporting it. If you want to trade alongside us every day and see exactly how I apply this in real time, our free trading community link is below. I'd love to have you there. Happy trading, and I'll see you in the next one.